Hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. And with me today, I'm excited to have Ryan O'Connor from the founder of Crossroads Capital. Longtime kind of value blog readers will know him as the founder of Above Average Odds Investing as well. Ryan, how's it going?
Good, man. How are you?
Doing good, doing good. Hey,
It's been too long.
really excited to have you on the podcast. Let me start this podcast the way I do every podcast, and that's by pitching you, my guest. I've been a super fan of yours, as I was telling you before we started recording. I remember Above Average Odds memos that you were posting 7 or 8 years ago, like extremely vividly. It was some of the best fundamental research I've ever seen on there. I know Crossroads Capital has been a great success as well, but when somebody comes on and says, "Hey, I've been a super fan of yours for 8 years, and I can still remember obscure investment theses from 5 years ago," that is the sign of somebody who really respects your work. So I am so excited to have you on. Appreciate you being on. And with that pitch out the way, why don't you tell us a little bit about yourself and your background that led you to founding Crossroads?
Sure. Well, first, thank you. You're too kind. It's kind of wild to think back to the blog days, but that's fun. So Crossroads, I started it about 4.5 years ago, June, middle of 2016. We run a kind of traditional value-oriented, special situation-centric, value-based hedge fund based off the Buffett model. The long story short is we, kind of our bread and butter is small and micro cap growth businesses undergoing some form of value unlocking change. That kind of fits in with the special situation bucket, and we kind of seek to find original insights into these ideas that kind of give us an edge. And with almost all of our ideas, we want to have a good idea of what's going to make it work and when. And for someone that focuses so heavily in the smaller, less liquid pockets of the capital markets, we found, I think, a large part of our success over the last 4.5 years is kind of insisting on a hard catalyst that will kind of benefit from the liquidity driven flywheel that is kind of part and parcel of the current regime, so to speak. So we've tried to evolve to succeed, and we've had a lot of success, knock on wood, and we hope to continue to do well. So I guess that's the quick and dirty.
No, that's great. And we're going to talk about Nintendo today. So maybe outside of Nintendo, could you give an example of kind of something that gives that, you said the hard catalyst that gets that liquidity flywheel going?
Sure. A great example would be a company called GAN.
I know GAN well. Yeah.
Yes,
we had Jeremy Raper on here. He was a big pitcher. I passed on them, and I'm happy to talk why. And it's it's a 4-bagger since there, so it's been killing me. But go ahead. You go ahead.
Yeah. So this was an example of a very interesting example in the sense that we started buying. I think it was in the fourth quarter of 2018. When it was, I think it ended up being something like, less than 2 times sales and, a single digit multiple on forward free cash flow. We got to know the executives, and, it was very clear that it was a very high quality business with, a lot of potential to kind of build a durable moat. At the same time, over the years, I can't tell you how many times I've witnessed, basically how broken the discounting mechanism is in the kind of the smaller, less liquid fare. And so, given this reality, you have the indexation vortex and, all of these structural factors, radical monetary policy that is kind of, pulling capital away from, call it our bread and butter, the non-indexed, a liquid owner operator run great businesses. And so GAN was, fit that kind of mold. But, over the years, we've seen, kind of general fact patterns and setups like that, where, by and large, the company executed. There were, for all intents reasons, you would have expected the stock to re-rate, given the earnings growth, kind of intelligent capital allocation, whatnot. But because, in certain situations, maybe the owner owns 30% of the equity, it makes it uninvestable from an index perspective. And, the kind of ultimate result of that is a stock that keeps on getting cheaper. So, regardless kind of fundamental information. And so, there I could go through 20 examples of how kind of broken the discounting mechanism is. But the way we kind of evolved to succeed was ensuring that, when I say a liquidity driven catalyst, that there with every idea, not only do we know what's going to make it work and when, but typically this has to do with finding setups where the institutional where there's massive demand, institutionally speaking. I mean, so from a online sports betting, iCasino standpoint, you don't have to be Einstein to realize that, this is, the scarcity of these, businesses and the quality of these businesses are going to be something that, the sell side and the street is going to trip over and drool for. So, it was a function of, ultimately gaining not only conviction and, lots of qualitative insights around the business itself, but finding, we wanted to know, we wanted to make sure that there was a hard catalyst there. And in this case, because it traded on the, basically the London version of the peak sheets, you had a scenario where the avalanche of demand for the stock, I think was somewhat self-evident. But because of technical factors, the stock kind of languished in this crazy, it was crazily mispriced. But at this, we also knew kind of a hard date, or the approximate date in which what you would see would be an uplisting, an expansion of the float, basically taking the actions required so it could get swept up in the slipstream of the liquidity kind of indexation vortex. So that's kind of the art of it. It is buying where in the structure, fish where the fish are, where everything's hated and the, price to value gap is as wide as possible. But then, that's not enough. I think, earlier in my career, if you knew why it was mispriced, if you knew, if you'd done the work, you knew it was mispriced, you could, confidently explain why that was, you could kind of sit back and relax, relatively self-assured that price discovery would happen, and the discount to value that you had identified would kind of quickly close. Well, things have started to change in terms of market structure, and so we just kind of weren't willing to take those chances anymore. So with GAN, we just had a very straight line of sight as far as not only what it should earn, if in terms of its normalized earnings power and its kind of inherent potential, but we also knew that as those barriers to investments collapsed and the business kind of hit its stride, that you were going to have basically an avalanche of demand for the shares try to squeeze itself into this relatively small liquid float. And good things usually happen to stock prices, when that dynamic is there. And, by and large, it has played out, beautifully. So, I think it was a 4-bagger heading into March of this year. And, I think it dropped. I think it was, I'm trying to think of split adjusted. It was, something like, dropped another 75% again. And, when we were, it was pretty clear early on, the implications with respect to how Corona and the pandemic were going to trickle down, and, how GAN was, not only not going to be hurt or impaired by this, change or dynamic, that, its underlying earnings power was actually going to, accelerate, demand or market adoption was going to be pulled forward. And, this was going to be objectively a very good thing for the business. And so, this is kind of the beauty of market environments like March, and it just proves the point that, these are the times we live for as investors, where, we were buying at, just a ludicrous valuation for, for a truly great business that was well run, that we knew was going to, basically deal with a violent convergence of price and value as these technical factors played themselves out. So that's pretty good. That's kind of a pretty good case study for thinking about how we didn't, we still stayed in our bread and butter space. but we did it in a way where I think the structural factors, that have been kind of hurricane force headwinds to all things small value, it allowed us to kind of, if not dance in the rain, kind of seek shelter from the storm. And it's been a very, of all the things that when I think back that in terms of how we've kind of adjusted our swing and improved our process, that is one of them that I think is one of the largest drivers of why we've been able to do quite well in a period where, has, under any kind of reasonable basis, been a very difficult time for small value investors like us.
So GAN was publicly traded, as you said, kind of pink sheets London.
Mhm.
Nintendo, obviously, they've got a US like OTC stock, but they're Japanese listed. Are
Right.
you finding are you finding more value outside the US than in the US, or like in companies that could at some point flip from outside the US to in the US?
So yeah, it's kind of odd. So we found a few very attractive ideas where the majority, either the sources of revenue and profit are global. Yeah, and it's based outside of the U.S., but the business for all intents and purposes. Nintendo is an example of this, where yes, it's a Japanese company, but in terms of its earnings power, Japan is a more minor piece of it. There's been a couple
Hmm.
Australian companies, for example, that have been large positions and winners that are either global or increasingly global, or entirely have the majority of their revenue and profit based in the United States as well. So it's kind of a funny thing where people will look at, if you were to look at our various investments, and they're domiciled all over the world, but the majority, in most cases, the majority of their earnings power is based in the United States, and they are much their sources of revenue and earnings are diversified far beyond their country of origin.
Great. And then,
So
I get I guess just building on that. So one of the things, there were a couple things with CAN, but one of the things I had trouble with was the argument was, look, it's already publicly traded, right? It's just on the London Stock Exchange, and they're just going to bring it over to, or I guess it was AIM, but they're just going to bring it over to the US. And when they do that, it's going to get 4 times the uplisting because DraftKings trades for a 10x revenue multiple, and Robinhood traders are going to get excited. And actually, that's exactly what happened. But like in my mind, every time I looked at it, I was like, markets can't be this inefficient, right? Like literally, they're taking
I
shares and
used to
moving
think
them.
that too,
Yeah.
but like I think these are kind of I think this is the fallout from the structural factors that have, or the things that have changed market structure since the financial crisis.
Mm-hmm.
I think of all the things that are different, it's the within these, again, the smallest, less liquid pockets of the markets, the type of name, like I think the enterprise value for GAN when I was buying it, I believe was something like 40 or 50 million dollars back in 2018. And when I started to really drill down into how kind of radical monetary policy in conjunction with the rise of indexation, the kind of the fallout from those two factors, I started to realize that let me put it this way: it seems there's been a variety of things we found that it's kind of a rub your eyes, check again thing. Can this be real? Why just things you don't trust because they seem so obviously just gross to me. It's like finding $100 bill on the floor.
Mm-hmm.
But as I part of being in this space and operating in this space for so long, or within these smaller niches, you see there were so many things that I have witnessed that just blow the mind. I mean, are so nonsensical and frankly ludicrous that I lost faith in the efficiency of the space in situations like these quite a long time ago. And I've seen businesses that are well run, very high quality, that crush I don't want to say expectations because, there's not a ton of coverage, but where objectively the business, has not only did well, but has done well, quite a bit well, better than what management had laid out, something that you'd expect the stock to go up 50% and watched it proceed to get cut in half. Alternatively, I've seen stocks that, because they are an index with relatively, tight floats, where the management are crooks, the business is, in all probability worthless, come into a print and you'd read the print and you'd think the stock would drop 90%. And because of an up day in its index, watch that stock pop 20 to 30%, based upon, simply its inclusion in a, relatively largely, used index, proxy. So when you see enough of those type of things happen again and again and again, it just, in some sense, it didn't surprise. I mean, it would have surprised me a few years ago, in March, or, say towards the back half of 2019, not so much, which is too bad. But, I mean, it's actually a wonderful thing, from a long-term investment perspective, but it is definitely something weird and new that, if we were to go back, say, when I started my blog in 2009, 2010-ish, you would never have seen. And then, you have also one of the secondary effects of the rise of indexation is the collapse of the traditional, equity management fund industry. And, frankly, good riddance. But, the people that historically were there to kind of drive price discovery have just had their head handed to them. And, the closures have continued to accelerate, the small and micro cap, mutual funds and, even hedge funds have done so poorly because of these headwinds that, it's kind of turned into a negative, vicious feedback loop where, I don't know what's going to break it. I mean, I know a lot of value investors out there are big fans and believers in the kind of a reversion to the mean as far as small, that small value will once again have it stay in the sun. I'm much more skeptical just because I don't, I think comparing the world in which, looking at past data and the circumstances, the nature of our economy, the fact that, post 2007, you have these, various other factors like radical monetary policy. I just, I think I've identified why the kind of all this craziness has happened, but the question that I have for the big believers in the reversion of the mean theory is what's going to change. If you go down each of the drivers that I think have determined where we sit today, with these kind of broken markets, the lower we go, I haven't come across a coherent answer that isn't basically basically they all amount to some version of we're at a historical spread, it's an extreme relative to large growth, and therefore that spread should compress. Until I think these structural market structure issues are dealt with, I'm not so sure that's going to happen. So, again, one of the ways we've kind of evolved to succeed is, hope is not a strategy. I don't want to take the chance that what if that reversion doesn't happen? The way we deal with that is by finding things like GAN, where stepping in and, we know, basically it plays to the current regime in a way that leverages, we kind of leverage both ends of the issue, the stocks that we're buying when they're outside of that indexation vortex and the beneficiaries of capital flows. We benefit on the buy side and the valuation side. If we can find something that, we get all that benefit, here over to the left, and then we know with a relatively high degree of certainty that they can start to party on, if you will, in terms of, the capital flow flywheel that is the primary determinant of, market returns these days, then we kind of get the best of both worlds, and I can sleep at night. I don't have to worry about, basically history repeating for, hope to my investors and, for ourselves. So that's kind of how we dealt with it.
You've used the term radical monetary policy a few times, and if I think back to the above average odds days, especially, I remember like the input capital, which was I guess it was royalties on agricultural products, if I remember correctly. That was it.
Mm-hmm.
And a lot of them were, I think a lot of the ideas, like I remember a couple energy companies, like I think there was a Yukon mining company.
Yeah, never listen to me on energy.
Say again?
I think with energy, it's been probably 7 or 8 years since I had been kicked in the face enough to realize that, this wasn't my sweet spot. And
okay. So I guess that was my question. So a big part of your evolution, it sounds like, has been moving on from especially energy, but a lot of these more heavy asset and mineral focused companies that you think would be beneficiaries of inflation, but
100%. It's funny. It's like, it's the natural, as a Buffett file, if you will, Munger may be one of my favorite human beings of all time. This is their own path. And, it's funny that it took me so long to kind of fully internalize the depth of that wisdom. Energy, for example, when you're looking at an industry that is basically a treadmill to hell, that has negative returns on capital over a full cycle, where management is generally, garbage, where there's asymmetries of information that, as a generalist, you can't really, it's largely impossible to appreciate. I could go on and on and on in terms of why I find, a lot of these asset heavy, commodity driven, terrible businesses uninvestable. In fact, input was a reaction to these kind of early learnings. I was trying to be cute and split the difference, where you could get that exposure towards some of the factors that make energy, at least kind of from a macro perspective, an attractive, or can be an attractive bet, but without sacrificing the qualitative elements that I think are foundational to, compounding wealth consistently at above average rates over time. So eventually, it's just not worth the heartburn. So, I started the day I started to cut out, what we can kind of just broadly call bad businesses and bad industries, was the days that, my returns, it was a very, very good thing. And, it's one thing, even to this day, like Value Investors Club, it astounds me how many energy names are written up. I mean, it utterly astounds me. If you go back and you read every single one, I bet you the average return on an energy name in VIC over the last 15 years is probably negative 50%.
I was going to say higher.
Yeah, right. It's unbelievable. And for the last 5 years, it's like, holy, why? Like why, of all the places you can fish in, and pick your spots, why would you subject yourself to this? I mean, it's just, I kind of laugh at it now, but for a blog called Above Average Odds to pitch, 4 or 5 energy names is deliciously ironic. Nonetheless, this is the game you learn. That was some of the, it was ultimately, it didn't feel this way in the moment, but it was some of the cheapest tuition I ever got. And it was, I think, a critical, not only learning experience, but has been essential to kind of making me the investor that I am today.
Let me ask you a slight pushback on that, because I agree, like, a lot of the oil and gas I've seen has been, hey, this company has, they've got a huge oil field out there, and if they can just develop it and the oil's there and they don't run over costs, like, you're going to make a good return provided oil prices don't go down, right? But like, I do think there is something, and I've asked this a lot, like the past 5 years, I think if it's taught anyone, it's taught a lot of investors, hey, if you have a good business, buy it, don't sell it at any price, no matter what, and you're going to return 40% per year, especially if it's an online business, And actually, right. If it's an online business, it almost doesn't matter at this point, because like, I didn't think Overstock was a very good business, and that thing's gone bonkers since they got a new CEO and like COVID and all this. So do you worry that, like, I think something like GAN, where you buy something that trades at a old line multiple and it should trade for a new world multiple, and it's just in a backward liquidation, like, that's always going to work. But do you worry that the learning, like, hey, don't look at energy, or hey, like, what you really want to buy is something online with infinite scale, with like kind of a flywheel? do you worry that's more a function of the moment and extremely low interest rates that can bring, if this thing's going to be dominant 20 years in the future, but the interest rate's 10%, you don't really discount that. If the interest rate's 1%, great, we can bring 20 years forward. Do you worry about that?
Oh, God, yeah, 100%. And to be clear, I think there are just as absurd examples of excess or things taken to the extreme, on the other side. Like anything, I think it's about determining, I'll give you an example. So we took a big stake in a company that looked, by any basic value metric, preposterously expensive. It was a little over a year ago, called
Can you name the
Afterpay.
company?
Yeah, Afterpay. It was based in Australia.
Okay.
And this is it's kind of like Nintendo, and where there's a large vocal contingent of smart sounding bears that it just mystifies me how radically wrong their analysis is, and the frame in which they view this business. On multiple levels. I mean, most of these guys don't even have a basic understanding of the unit economics, and they oversimplify things. And so here's a stock that will never look cheap, based on traditional kind of GAAP-based metrics, because it expenses its growth through its income statement. And there's a variety of other hidden layers of value here that can't be quantified through the rear view. It's not going to show up in book value or the traditional things that are going to typically interest investors or value-based investors. So the interesting with Afterpay is I had a friend kind of give me a heads up on it. We kind of started to dive into the due diligence when they had entered the United States. A mutual friend knew the guy that helped launch their U.S. business. So we were able to get him on the call and kind of walk through their unit economics. There's various moving pieces here. But the whole point is if you're dealing with a marketplace, say a two-sided marketplace, for example, it's essential to figure out not just the value proposition to both sides of the network, but to in this case, get an idea of, things like, lifetime customer value, running the analysis in terms of its capital efficiency and how it would scale if you understood the unit economics, and you could basically put through get an eye for customer acquisition cost and lifetime customer value. And when you put the pieces together, I saw a business that through the rear view is trading at 40 times sales, but something like, 1.5 times free cash flow on a normalized basis, 5 years, assuming none of the platform optionality is realized. I mean, largely various, pretty, I think, draconian assumptions. And, I remember the guy that had initially turned me on to it. I mean, if the stock was like 20 at this time, now it's over 100, but, it was one of those things where it was kind of like Atlassian, where it's capital efficiency and its scalability is just kind of rub your eyes, check again, is this real? And we started, basically at the rate it was acquiring customers, what the steady state earnings power would be looking out a few years based on very, very, almost preposterously conservative assumptions in terms of its user base. And you were looking, let's just put it this way, it was a very large multiple of its current price. So I think most of the things, I think there's a lot of froth, but I do think that you just have to focus on economic reality, not simple heuristics. You have to understand the business. And so yes, I worry that things are, you have to be flexible. And, as you noted, when this call began, there's this wild dispersion between asset classes. And even within the high flying, call it software, tech platform, what's hot right now, there are wild discrepancies between, there are lots of high valuations. I think some are, way too low and some are way too high, but, it's just not, using I think you have to be very wary of, this is why I hate the distinction, but, growth and value. I mean, they're the same thing at the end of the day. And what I'm looking to do is, figure out what a business is worth under, my ability to understand what its normalized earnings power can be, with a relatively predictable kind of a tight range of future outcomes is very, very important. And so that's what I focus on. And I try and honestly block out, the whole growth versus value, it does nothing but kind of poison your psychology and, scatter your ability to focus on what matters, free from the peanut gallery, or, oh, this looks expensive, this isn't a value
Yeah.
stock. Well, bullshit, it's not a value stock. I mean, you get into that whole thing. So, there are exceptions. I mean, while the vast majority of what we own, we've bought in a statistically cheap sense. It was statistically cheap, and it was very high quality. And, that's a beautiful combination. But, given the way, I mean, if you look at the businesses that have created the most wealth over the last 20 years, the ones that have compounded shareholder wealth at the highest rate, you would never, I mean, they never at any point in time ever looked, statistically cheap based on trailing 12-month math. GAAP accounting will never capture what these businesses are doing in a way that makes sense under kind of that old framework. So, I think you have to be, I think being overly simplistic and dogmatic about, only buying statistically cheap stocks through the rear view, or, I think that is a very costly thing. At the end of the day, I want to find a business that I can buy today that is, valued at a tiny fraction of what I think it will be worth 5 years from now. And I think to do that right, you can't let, kind of certain dogmas or articles of faith, of say the Fama French school, or, you just can't let that stuff wiggle its way into your thinking, and I think it will negatively affect your ability to do what you're here to do, which is find grossly mispriced stocks and hold them long enough to realize the value of the insights you've uncovered.
Perfect. No, that was really well said. Okay, so let's turn over to Nintendo. I'm sure most listeners are familiar with Nintendo. This is the company that made SNES, Mario, Zelda. So I don't think we need to do background on this company. They're one of the most beloved companies in the world. Mm-hmm. So rather than give background, why don't we just dive into, I know you run a concentrated portfolio. I read your 2018 letter, which I'll be sure to link in the show notes. You're hugely bullish on Nintendo, right? So why don't we dive into, why are you so bullish on Nintendo?
Whew, it's like, why do you love your mother? There are so many reasons. It's hard to know where to begin. And that might sound hyperbolic, but I genuinely believe it is an extraordinary company that remains extraordinarily mispriced. But the long and short of it is, I think Nintendo is at a pivotal crossroads, if you will, where, through the past, both in the industry and Nintendo in particular, you had this hit-driven cyclicality to the business model, that made, accurately underwriting, what Nintendo's earnings power will be, a few years into the future, by and large, impossible. And the result of this was a discounted multiple. Mm-hmm. So, one of the things that initially drew me to the story, and kind of the original insight that I think is the primary basis and the foundation of any intellectually honest Nintendo thesis, is the dedicated console segment, and how that business has been transformed from this kind of hit-driven roulette scenario where every 5 to 7 years they would come out with a Wii or a Wii U, have a quick prayer session and, hope kind of for the best that they can bootstrap sales of that system, with their own software, to basically a software platform that is, based on an iterative hardware model, a la Apple and its iPhone. So, the idea is basically that, like with smartphones, new versions of the Switch will be backwards, compatible with all games released so far, while becoming, more powerful and feature rich over time. much like if you were to compare the original iPhone in 2007 to hell, even an Apple Watch today. But the net result of that is not only will that tend to keep customers locked into Nintendo's entertainment ecosystem, and buying its exclusive first-party titles, and making the business materially more profitable with, instead of highly volatile revenues, very stable, very resilient recurring revenues at increasingly high margins. And that in and of itself, I think, is a profound game changer. Basically, instead of its installed base of users every 6 years, dropping to zero, where they have to go ahead and reacquire all those customers again, and then pray that their games will, kind of bootstrap, that console system to, kind of a minimum viable scale of, users in terms of the installed base. All of those issues and all of the headaches and problems that were kind of a natural result of that dynamic have gone away. And looked at a different way, I mean, basically saying the same thing a different way, the Switch family of systems, I believe, is by and large forever, not forever, but it should be perpetual. And we'll see this, there is no more cycle. I think the idea of next gen cycles, specifically with respect to the Switch and what Nintendo is doing strategically, is kind of an incoherent term that is based on an obsolete paradigm that makes no sense looking forward, if that makes sense.
No, I think that was great, and I think you hit a lot of points in there. But if I summed it up, and you hit on this a little bit, when you look at Nintendo today, you almost see Apple's transition from, let's call it 2014 to 2018, where in 2014 all the profits is hardware. Now they did have, there was a really nice it was a really nice smartphone that was light years ahead of everyone, and like when you upgraded iPhone, you got to take all of your stuff and your contacts and functionality with you, but all the profits was hardware. To today, where I think like a third of their profits come from the services, just the App Store, that App Store tax. And in Nintendo, what you see is, most of the profits was, hey, we released the Wii, we released the Wii U, everybody buys the Wii, we get that, and then we'll get profits from selling our games on it. But what you see going forward is, I get a Switch, and then I sign up for Switch Pass, $10 per month or something. All my games are on there. I'm going to pay that $10 per month stream forever. And by the way, at some point, if I want to buy Call of Duty or Mario or something through the Switch Pass, Nintendo will also, similar to the App Store, take a tax on that. Am I kind of thinking about that in something that?
Yeah. I mean, I think that's a part of it. There's a couple moving pieces. At the end of the day, you have, the Switch itself. So one of the unique things about the, actually, let me see if I can find something. Historically, with consoles, you had kind of custom designed, parts that were made specifically for, each, individual system. So you even still see this with, the PS5 and the next generation, the Series X at Microsoft. Well, one of, I think, the tells here for, not only the direction that Nintendo is going, but that speaks to kind of this larger transformation, is that Nintendo decided to go with basically mostly off-the-shelf mobile parts, i.e. by creating a system that could benefit from not only the innovation within the larger mobile ecosystem, but benefit from the deflationary cost curve that is kind of part and parcel of that. That tells you that that is, in large part, and there's a lot of factors here, that tells you that, over time, it will be very easy to, continually iterate and improve upon, new, form factors and improve the hardware over time. And it's really all about the software, kind of as you put it. So by doing this, not only will they create kind of a long-tailed, console that will allow them to sell their own first-party IP at increasingly high profit margins as the ongoing digitization of sales keeps happening. But to layer on, they looked at another case study that I used in my annual letter last year, a link to the past, if you will, was looking at how Sony and Microsoft used hardware as, the basis of a reoccurring, digital revenue center. And so you see that too with, I think you're referring to things like Nintendo Switch Online, which I think will eventually be a library of vintage games from all their, or retro vintage games from old, consoles, and basically becomes like a Netflix of gaming, for kind of classic retro games and that kind of stuff. But there's also the possibility when you think about call it the streaming platform wars of the future. In a world where you have infinite checkbooks from companies like Apple and Google and Amazon, I saw one of your questions when you put the kind of the bat signal out on Twitter the other day. I'm trying. I just lost my train of thought. What were we just talking about?
You said infinite checkbooks, and I think you were going to say if any of these guys wanted Nintendo, they could pay a fortune.
Well, yeah, Nintendo's not going to sell themselves. I wish that was a possibility. I do, but there's no chance in hell Nintendo is going anywhere into them. But what makes this interesting is that when you think about all the other, so let's look at Microsoft and Sony. They have all third-party developer. Basically every game on Microsoft is going to be on Sony. They have very little first-party IP. That's what I was referring to in terms of the one of the questions from your tweet. The importance of first-party IP, and you saw Microsoft just buy Bethesda, but by and large, people think about video game consoles and they think that, what sells consoles is software. And in order to differentiate yourself, as a streaming platform, the way it is now, and I honestly think, Microsoft can buy Bethesda and, and Sony can continue to incrementally bolt on, its own, to build out its own first party IP library. But ultimately, I think when it comes to something like this, from a competitive standpoint, it's too little too late. Say Sony comes out with its own streaming service, and Microsoft does the same. Microsoft's clearly the lead, and I think we'll run away with it. But the point is how do you, in a world of infinite checkbooks where money doesn't determine what's going to differentiate your value proposition versus the next biggest player, there's only one answer to how you win, and that is bring Nintendo games into it. Like maybe Nintendo strikes a licensing deal where the first Breath of the Wild and Mario Odyssey, they take 10 games and they put it on one of these services. They put it on XPass or something like that. Not only will that create hundreds and hundreds of millions, potentially billions in pure margin reoccurring free cash flow, but it just speaks to the way in which ultimately when I think about not only Nintendo's moat, but who's going to win in the future, there is no world where Nintendo is not one, a part of that, and two, in a kind of a prime position to monetize their decades of peerless IP in ways that I don't even think it'll be very interesting to see the way Nintendo continues to monetize its underutilized world-class IP that we haven't even considered. But it's all about the software at the end of the day, to kind of go back to your question. And there are various ways in which they are not only diversifying their revenue stream, but becoming, largely and eventually, I think entirely, and when I say eventually, I mean 5-10 years, digital. And the cumulative impact of all these things is very, very profound. But
let me push back on that a little, because I lean more towards the bull case, and I've looked at them a lot, and the worry I always have with Nintendo, right? And if they would put Game Pass on, if they would put games onto Microsoft or Sony or something, I think this would alleviate.
It's going to happen, but I think they've been flirting. There's a ton of clues, much like kind of the mosaic of facts that we laid out with the transformation of the dedicated console segment. I think if you dig beneath the surface, there is an avalanche of clues that it's only a matter of time before you start to see a tie-up between Microsoft and Nintendo with respect to their games. And in fact, I've been told that Microsoft would have already done it, that they are basically waiting for Nintendo to give them the green light. But
We can push.
I think that's near. I think that future is nearer than most people suspect.
We can push on that side then, because I'm hugely bullish. I love the IP. Like for a while on my blog, I had the quest for IP, right? And I always think of Comcast paying for DreamWorks. They paid so much money for DreamWorks because they had these great characters. And like, there's no company that has better characters than Nintendo, aside from Disney and Nintendo, right? And
Sure.
if Nintendo was for sale, Disney and Comcast would go wild bidding for this.
Disney,
Comcast,
Apple, Microsoft, Amazon.
Oh yeah.
All of them.
Tons of I think Comcast and Disney could be the best monetized.
I actually agree.
So, the case you were laying out just there was Nintendo's going to license some of their stuff to Microsoft. And when I say that, I say great, because one of my bear cases for Nintendo is if you keep all of this in a walled garden, right? You have almost, like Cobra Kai on Netflix. Nobody watched it on YouTube. It goes to Netflix, which has great distribution, and it becomes a hit. Nintendo, you could run a risk, like with Wii U. There were some great games released for Wii U. Wii U was a dud, so all those games had no cultural impact. If Nintendo stays everything walled garden, I worry about that risk. If they go the other way and they put all of their stuff onto Microsoft for some huge licensing deal, which I'm sure will be crazy profitable, but then there's no reason for me to go over and buy the Nintendo system anymore. I can just get access to all of it over on the Microsoft system. Then Nintendo's just a game developer. Are they a great developer, the top game developer in the world? Absolutely. But like, you need more than them being the best game developer in the world with 4 iconic properties to justify the current valuation.
I might disagree with you there, but I'll grant your point for purposes of this. So one thing, so here's an interesting kind of side tidbit. So not this most recent quarter, but if you look at the prior quarter, you see I think it was roughly $150 million uplift to R&D. Without getting into the weeds, that is a absolutely extraordinary increase in R&D relative to Nintendo's history, at least as far back as the financials that I have go. I think when you see the arrival of Value Act, which obviously was instrumental in the digital transformation, of a similar vein to what kind of Nintendo's doing here, when Value Act shows up, and you look at this massive uptick in R&D, which this is there's no way this is that amount of uptick, this increase in spend, I think is related to beefing up software or hardware. There's a couple different reasons I say that, but I think the only logical conclusion is that this money is going towards the cloud. So this might be money spent in the cloud to do a tie-up with Microsoft, and in lieu of providing kind of the infrastructure in Japan, allow Google and the XPass to actually get real market share in Japan, which it's kind of a joke. I think they sold like 2 Xboxes last year. So that's a huge strategic goal for Microsoft. And more importantly, it sets the stage for Nintendo to, create, this Netflix of gaming that you kind of led with, which is, a digital, think of it as an app. You can basically play the 10 games that, Nintendo licenses to XPass through your XPass pass, but you can also upgrade and buy, we'll just call it Nintendo Switch Online, on top of that, and then get access to everything digitally. But there are lots of ways in which at the end of the day, what sells consoles are great games, and Nintendo is the GOAT of simply magical games that are, in some cases, I think I don't think it's absurd to call them high art. So I think as long as they develop the capabilities to reach consumers digitally, that fit kind of the contemporary, world, there is always going to be, I worry more about Nintendo's willingness to kind of press and leverage their advantages and go full speed into doing this than I do their ability to. I don't think they'll ever be boxed out because they create the greatest games on the planet. I think they're the most talented, most creative, video game developer of all time. And I think if you read the tea leaves and you see the green shoots, they are, actively not only spending money to lay that groundwork for the future, but they have a very large swath of options. I mean, if Nintendo came out tomorrow and said, guys, we're done with consoles, we're just going to, we're going to put our first party IP on everything, the stock would quadruple. Because, all of a sudden you're selling into, it would be there's so many different ways and levers and escape hatches, for Nintendo to be worth multiples of where it is today, even if, certain elements of their strategy don't play out as, they expected. That at the end of the day is what lets me sleep at night, is there's just such an extraordinary margin of safety. And part of this is also related to what you just highlighted, which is, this IP. I mean, Mario, Zelda, dozen plus franchises that literally mint cash decade after decade, year after year, new game after new game. There are very few IP in the world, in any industry, in any space, has the ability, not only the enduring durability, but the ability to consistently generate gobs of cash flow, simply by, releasing the next game. So at the end of the day, it's not just what I would call the king of the video games, but its IP library, its moat is in its IP, and more effectively and efficiently monetizing this gold mine over time is something that, it's barely even begun. I mean, we're starting to see next year. We'll finally see Super Nintendo Land open up. We'll see the Super Mario movie be released. Now, Nintendo actually funded a large part of this, so the impact to its earnings power is going to be substantial. You can back into the contribution from the existing agreements on the parks. You have the retail centers. I mean, I don't think they think this is probably one of their last priorities at this moment, but they could pull an Apple and build 500 stores across the world, and they'd be packed day in and day out. When I think of Nintendo, if I had one word to describe it, it would be optionality. I mean, there are, it almost seems absurd, but there are 25 different ways that I think they could create billions of incremental value out of thin air overnight. And that is something very unique and special.
So I agree with you. I think there are, when I look at this company, beloved brand, limited distribution, like I think there's so many ways, and I'm glad, like the Mario movie, like I know the 1990s Mario movie was a disaster, but it is perfect for the Illumination team. That's the team behind Despicable Me to go make it. In Super Mario World, I mean, this is perfect. And like, these things are long overdue. But speaking of long overdue, we talked optionality and monetization. Like, one thing I worry is they should have had Mario Parks 15 years ago, right? Like Hunger Games as a part. And I worry that Nintendo's culture, the culture that lets it make such great games, is also a culture that will kind of keep it from a lot of these optionality and monetization opportunities. I think of something like World of Warcraft. Why couldn't that have been World of Hyrule, right? Or Breath of the Wild. Famously, they said we're going to do lots of downloadable content for Breath of the Wild. Breath of the Wild was a work of art. People spent hundreds of hours in that game, and Nintendo only got $60 from them, right? Like, if you look at something like Grand Theft Auto, people spend hundreds of thousands of hours in that game, and they're just monetizing that thing left and right. So is there something with Nintendo's culture that's going to keep them from realizing all this optionality that you and I see? And then I'll have a follow on to that in a second. But
So 2 points. The first is you have to kind of, I think, distinguish between the changing of the guard that started to begin in 2015. Furukawa, I think, is very, I think, the CEO and, by and large, the Nintendo, call it exec suite in general, is on board, living in the future, and, focused on innovating and, delighting, people through innovation. I think that, when a lot of the examples that, you touch on from kind of the old guard, the only one that is left, I think that is kind of a big roadblock here. And he's also in a sense sort of one of their greatest assets, but it's Miyamoto on the board level. So, but most of that friction has come with respect to mobile. And, I think there are very good arguments on both sides. I actually think the death of mobile is wildly underrated. You don't believe me, for anyone listening here, I dare you to download Mario Kart Tour, play it for 20 minutes a day for 2 weeks, and you tell me, if you keep playing or if it's a fun game. So I'll leave that.
I will be more than happy to take you
All
up.
right.
Please
do. I'll send you my code. We can battle online. Actually, a few of my colleagues in this industry, we're very competitive about our Mario Kart Tour. I think the culture and the mindset and the kind of insular inflexibility that defined the old regime that was leading Nintendo is by and large gone. Second part, and I'm trying to think, I'm trying to remember the full part of your question.
That's right. I think
your question. There's a second part of this that is important to close the loop.
Go ahead. So the question was just on, are they going to take advantage of that optionality and that?
Oh yeah. So I think the things that were, kind of like the barriers to investment when it comes to, something like GAN, because of the London name, those have collapsed. Well, I think the largest barrier, there's still Miyamoto on the board, kind of standing in the way of certain things. But I also think that's very smart and long term. When I think about, I don't want Nintendo to, put itself in a position where, it basically gouges kids' eyes out with, gotcha mechanics and, where it basically turns into a casino. So, there are a lot of big, huge games that mint money that I think it would be a mistake and it would betray. I think Miyamoto is right when he, is standing on principle to protect the family-friendly nature of Nintendo's moat. I think it's all about how you experiment with monetization. So, look at Mario Kart Tour and the way that Nintendo has pivoted towards, a subscription model. I think there are lots of ways in which Nintendo can continually enter and leverage its IP into, kind of interconnected, networked, multiplayer games, and do that very, very well in a kind of a variety of different ways. And I think, on a very small scale, you've seen things like Tetris 99 and, casual gamer things, or the new Super Mario 35. I think when you break it down, I think they are creating games and using their IP and in, leveraging it in kind of adjacent ways that they have not in the past, that I think not only plays to the future, but will be very, very successful, or at least certainly reduce churn and increase the stickiness of their, online digital reoccurring, subscription services. So I don't think there is, I don't think they're stuck in some past, unwilling to do. It's not like they're only going to make platformers for the rest of their lives. I think just the way they innovate with what used to be, like 2D Mario platforms, I think is remarkable. Look at Breath of the Wild. So, and Breath of the Wild did have, 2 very large, amazing DLCs. And my understanding is that Breath of the Wild 2 was supposed to be it was supposed to be, you're seeing this with, as we speak right now, with all of the big franchises. You just saw 2 more DLCs get released for Pokemon, Animal Crossing, DLCs coming down the pipe. Smash Brothers continues to release new fighters, not just that first year after, coming, but that second year, like this is a recurring phenomenon. And I think it's kind of somewhat masked here because namely the one that came out first, Breath of the Wild. After they released the first two pieces, they realized they wanted to take the third and make it into Breath of the Wild 2.
Yeah.
So there are again, not only you say they sell a game for $60. Well, they sold a game for $60, and then they sold two pure margin DLC packages on top of that. That if they weren't making Breath of the Wild 2, that next year they would have added two more. And so all of a sudden your gross margin, quickly goes, from say 50% to 85%. And, there's, Animal Crossing, they could innovate and have in-game. There is the only thing that will stop them is, management themselves. But I think there's no real paper trail or way to look at the empirical evidence of the last few years and make the case that they are not only focused on these levers, but, doing them quite well. If you could go and look at the way fans have reacted and look at the DLC and the ongoing, reoccurring ways they are monetizing, these recent games, first party IP games that they've made. But, they are incredibly not only well done, but I think if you look at their attach rates from owners, they are very, very high. So there's, in each space, we could talk about mobile, console games, things like Nintendo Switch Online and the untapped pricing power they have there, and their ability to, as they build out that library, create a Netflix, subscription-like service where, it's basically an app you download and people pay $10, $20, $30 a month to, play the latest and greatest, where, maybe XPass gets, the first generation Zelda and Mario, like the stuff that's been out for a while, and their own online, app, if you will, is, where you find the latest and greatest of, their, developments.
Let me push back. So I think there's two push. Like if you've got, Netflix, nobody watched Breaking Bad on AMC for the most part, right? Most people watch it on Netflix. So you weren't getting it up to the date. You were just getting it when it binged onto Netflix, right?
Right. Right.
So I do think you cut into a little bit of your value, but I think this speaks to the second worry I had, which is, Animal Crossing, breakout hit. I think 25 million copies sold. Breath of the Wild, 20 million plus copies sold. These are huge numbers, but I worry the value is Zelda. I worry that Nintendo's at its maximum value and maximum optionality right now. And if they don't strike very quickly, they will miss out on a lot of it. For instance, Roboblox, 150 million monthly active users versus we just talked Animal Crossing sold 20 million copies. How many monthly active users is that going to have as the Steam wears off? Like 1 million? I don't know. But there are games out there that are cross-platform that are at scales that are far dwarf Nintendo. And I worry, like, one of the reasons Zelda is so popular is you and I grew up with Zelda. We've got that memory of it. Kids grew up with Zelda. Today's kids might be growing up more with Roboblox or Minecraft, particularly if the only way to get Nintendo is to buy the Switch and shell out $300. Maybe parents are just pushing a lot of kids over to the free Roboblox or something.
Yeah, I think this was part of the reason for, entering the mobile space is kind of this train of logic, in terms of, how do we continually reach people, and young generations to keep our IP relevant and popular, just how do we kind of fix this problem? And so obviously, having some focus in the mobile space allows Nintendo to reach, and put, smiles on kids' faces everywhere in a way that, they can interact and come across. So I would just say that, we've seen them take actions. It's clear they are self-aware of this risk and they are taking actions towards that. Remember, this is also a big piece. This, not only mobile, but this ties into the theme parks and the movies.
Yeah.
These are the ways in which we use different forms of media, from movies to brick and mortar retail to kind of, continually replenish this relationship with, the young gaming community. At the same time, I also, again, I point to their financials, a lot of the clues here where, I think it's clear they are spending money in a lot of money that, is most likely going towards, some cloud-based solution that, if there's any Achilles heel with Nintendo, I think that I constantly worry about, and I'm very, I'm up to the minute in terms of, understanding kind of where they're at. It's their online play. It's their ability to create networked games that, that faithfully recreate, the experience of the game itself on a console. And, I would just, who knows, the future is uncertain. But yeah, is that a risk? Certainly. Do I think Nintendo is making the right moves to, kind of reinforce and defend against, those risks? Yes. But you say something like Roblox. I just put it like this: there's, creating the high art of their games. They're, just from a developer standpoint, these are the best there's ever been. Nintendo is just magic. It's games that drive ultimately Roblox is huge because, obviously people really dig it. I have all the confidence in the world that the, mad scientist geniuses at Nintendo will always find a way to create games that people love and enjoy. And as long as they are open to and actively moving towards a future where, they are putting those IPs in, into that, those IPs can be played in ways that speak to what you're talking about. That they will be, I don't think it is from a fundamental price to value standpoint, the stock could triple based on the value of the dedicated Switch console alone. Zero out all the minority equity stakes, Pokemon, Niantic, the billions in cash, the Mariner stake, all that stuff, and you have a very big win. If you're thinking out 10 and 20 years in terms of, their ability to continually expand the size of their moat and stay relevant, I think that the groundwork is being laid as we speak to make sure that their place in the gaming ecosystem, is always, intact. So I don't have the perfect answer, but I don't see everything I see at the margin. Their actions, what they say, what they've done. It's not something that keeps me up at night.
Last bear case, and again, I don't mean to hit the bear case because I'm actually very bullish on the company.
Yeah,
I
hit me with
the
bear case. That's what we're here for.
This is the company. This is a company like I want to buy, but like I look at them releasing Mario Kart Tour without any multiplayer capabilities.
Yeah,
what was it, like 6
totally
months?
moronic. Yeah, it was totally.
And you look at it and you say, how can a company they released it in 2019, I think. How can a company in 2019 release Mario Kart, which is, I've got great memories playing on N64, and like it's literally the game meant for get 7 of your friends and play it. And with mobile, it should have been dominating. How can they release it without it? And you look at it and you say, have they really gotten the memo? Do you worry about that at all, or do you just think it's very slow?
So I did. So when it came out with that multiplayer, besides just there was a lot of questions that it introduces. But I will say this, as someone that has the gold pass, that has played it consistently, I didn't play video games for 20 years, and now I've gotten back into them for research.
Now you have to be a pro.
Yeah, right. Research, because so I've gotten not only back into kind of the games that I grew up that in some sense define part of my childhood, like Legend of Zelda. But the first mobile game I've ever played is Mario Kart Tour, with some level of I play it probably 20 minutes a day, and part of what I think, I think the way the game has evolved and changed since its release. This is why I threw down the gauntlet challenge. I think that 90%, in fact, and when I talk to people, it's probably closer to 98%. When people hate on Mario Kart Tour, they're talking about, one, the strategic misstep of not launching with multiplayer, but the truth is it wasn't done. So, they either delay the game another year after they'd already delayed it in the first place, or they put it out there and they start getting data to iterate and improve the feedback loop on. And, so did they waste the 123 million download opportunity that would have, kind of kickstarted the multiplayer network effect? Yes. But so did Pokemon Go in a lot of ways, initially, where it was a massive hit right out of the gate, but there were tons of problems. A lot of stuff that people loved about Pokemon was missing, but they iterated and improved and figured it out and leveraged that kind of feedback loop to create a game that has consistently gotten better and better and better. And you've seen that translate into active users and the game's kind of fundamental earning power. And so with Mario Kart Tour, anyone that actually plays it and that has played it consistently through time, as they've added new not only multiplayer but landscape and various features to the game, and if they've tweaked the graphics and created cooler, I think Mario Kart Tour, and I say completely sincerely, is more fun than Mario Kart 8 on Switch. I think it's twice as fun. And I'm not, this is certainly one man's opinion, but the gameplay at this point is utterly fantastic. And I think it will take time, but it's good enough that I think you'll have a similar dynamic with what you saw with Pokemon Go, where you have this explosion in active users, then it just basically drops through the floor, and then it slowly, steadily rebuilds as they iterate and improve and leverage the feedback loop that they get from just observing and analyzing what people like and what people are doing. So to me, they're doing it right, and they're doing it remarkably right. And if looking at the way that the qualitative way in which they've done these things, people say that they've kind of abandoned mobile. They haven't abandoned shit. Like, they are making the game materially better by significant orders of magnitude with every 6 months that passes. And I think we'll see that kind of stuff continue, not just in terms of mobile subscriptions, but other subscriptions from other IP into the future. But we'll see.
Well, I can't wait to download it and play it now. But 2 more questions, and I'm going to let you go.
Sure.
We mentioned a lot of upside optionality for the company. Putting their games onto other platforms, getting the Switch going. At some point, they're going to have a part of a lot of different parks. They could roll out Nintendo stores all across the world. I used to love, when pre-pandemic, when you could go places, I used to love going to the Nintendo store every now and then and just checking out. Of all the optionality pieces we've talked about, there's some that would drive the biggest near-term kind of pop in the stock. But what's the one that over the long term you're kind of the most excited about for value creation?
Ooh, that's a good one. That's a great question. Most excited for I'll go with the dedicated console segment's transformation, specifically the release of the Pro, which I think we're going to see in the first quarter of next year, simply because of how it unlocks not only a massive additional market, but creates a floodgate of additional optionality for third-party AAA, or I guess now it's quadruple A. I guess that's a thing. Games that were impossible to faithfully recreate and put on a Switch because of power issues. So with the Pro, I think it acts as because Sony has pulled out of the portable space, the Vita's gone. It's kind of like a Trojan horse form factor. If you can create current gen and then eventually next gen games as hardware iterates and improves in terms of specs and kind of power, you create what was never possible before, which is what the hardcore gamer set playing Call of Duty. The ability to play Call of Duty portably and on the go is an absolute freaking game change. So you not only have the barrier to third parties putting the most iconic, most kind of spec intense games into Nintendo systems is about to drop. or collapse entirely. That has a number of very significant repercussions, not only in terms of driving incremental sales, in terms of the hardware, but in terms of software, you automatically, open the door that has been kind of the biggest barrier, certainly in the past, to kind of, setting that network effect on fire for Nintendo. Nintendo is going, think about eShop and, think of Call of Duty. Think if you could play Call of Duty as you could on, the Xbox One or the PS4 Pro. And you could play it, with, zero, the fidelity of it, was, perfect. How many games that would sell? I think it'll do two things. And not only will it confirm the iterative hardware, software platform, it will also show that, I think it'll bend the tie curve, the tie ratio up, and it will make Nintendo's portable basically a portable for all gamers, not just necessarily, kind of the Nintendo, fanboy. So that actually wasn't articulate and as eloquent as I could. If I could write down, give me 10 minutes to write down all the bullet points, I could give you a better answer. But, I think that is what excites me the most, because, as it stands right now, I think most people on the street, even long investors, still view the company through a cyclical lens. And, the assumptions embedded into a lot of the street's estimates will, not only will kind of the pillars, drop in terms of like the basis of their, I think this could be the thing that starts that chain reaction of epiphanies and wakes people up to a future that, even with the stock having doubled, is still, very few people see, I think, what, a few of us see. And when that psychological change in terms of sentiment happens, I think that's going to, drive a lot of, obviously through their financials, but more importantly, I think it's going to put this is the thing that's going to make the stock trade something closer towards reasonable, given what I think it is highly probable to earn, in terms of steady state earnings power 2 to 3 years from now. So that's the catalyst in the near term that I think will be probably the largest driver. But who makes the most money over the long term, from all these various levers? Mobile could be worth multiple the current enterprise value, assuming they were to get it right. Movies, if they're, taking half the box office, well, there's questions now, I think.
Are we ever going to have a box office?
Yes, which is horrifying, and it's something I never thought possible, but I think it's actually in fact, I have a movie theater rented in Kansas City on Tuesday night, where it's just me for $99.
I've been wanting to do that.
13-year-old Ryan is over the world.
Bring your own popcorn. No, I guess, and we're going to have to wrap this up, but movies, you said it. And I just think, like, you look at the Disney virtuous cycle where Marvel drives the Marvel universe, which they can then use to drive people to sign up for Disney Plus. They can use it to create new rides, like Nintendo has that flywheel. And
think of Zelda on Netflix. Think of like a Game of Thrones, whether it be anime or live action, there are 20 ways Nintendo could create billions of dollars in value to its equity, literally overnight through a stroke of a pen. We're seeing rumors of Zelda with Netflix now, actually.
The Witcher on Netflix, right? Like you think about something like I could list off 10, if you gave me an hour, I could list off 10 stories that we could go 5 seasons each on Netflix in the Zelda universe. Like there's so much that's unexplored.
Totally. So the point is, like I said, one word to define it: optionality. If any of these high impact shots on goal land in the money, Nintendo investors are going to be very happy.
Well, hey, I think that's the sum of a bull thesis. So right. Ryan O'Connor from Crossroads Capital, look, this has been great. I pitched you at the beginning. I think our readers can see how sharp I think you are. So appreciate you coming on. We'll be in touch, and have a good one.
Anytime, brother. Thank you.